Okay, we are doing DIT and consolidation, and we are on page 9. And we're going to work through example 6. So you can just read through that yourself. I'm going to just lead you through the example. In a business combination, the carrying amount of an asset, so on their books, is reflected at its fair value of $20,000. In the general ledger of the subsidiary, the asset has a book value of 12. So that's in the subs books. And this would be on consolidation. The subsidiary's tax return, it has a tax basis of $9,000, which of course, as we know, is unaffected by the business combination because tax is calculated on the separate entity's books. Tax rate for parent and sub is 40%. At acquisition, the implied the sub was $100,000. The sub's common shares totaled $40,000. Retained earnings was $50,000. Now, the parent has a DIT asset totaling $50,000 on its single entity books. So, essentially what we want to do is figure out the DIT balance for the consolidated statement. But to do that, we're going to work through little pieces. So, first we need to know, does the sub have a DIT asset or liability on its books? Because it doesn't tell us here. So, we're going to do our books. We're going to do tax, and then we know it's about an asset. So we're going to put asset balance. So, on the books, the sub has it at $12,000. And its tax basis is $9,000. So that would be its UCC, and this is its book value. So we take the difference, just like we did in those other examples on the other video. 3,000 times percent is 1,200. Remember, we have to figure out if it's a DIT asset or a liability. In the future, now remember, compared to the accounting, so here, we've used up a lot of the asset by this year. So future you doesn't have very much to use up and deduct as the accounting does. So is future you happy or sad? Well, in the future, you're sad because deductible expenses are more used up than accounting. That is his little sad face. So it's a DIT liability. So we know the sub is starting with a $1,200 DIT liability. Okay? So moving on to page 10. Now we have to say, well, what's the new deferred tax asset or liability that's going to be recorded? Because when we do a consolidation, we don't use the $12,000 of the sub's book value. Remember, we would write it up to fair value. And we said on page 9 that the fair value was $20,000. So, on the consolidated books, we've got a balance, an asset balance of $20,000. And on tax, has it changed? Nope. It's the same. So for consolidated purposes, we're going to calculate the difference. That's 11,000 times 40% equals 4,400. And again, just like the other one, tax is lower, so it's a DIT liability. And that's because the future you has less tax deductible expenses. So what we have to do then for consolidated purposes, we need to change the subs DIT to 4,400 DIT liability. Sorry, that's a little squashed in there. So, we're going to take care of it in the calculation of the acquisition differential. So, this is going way back. So, we start with the implied value. Which was already given on the last page as 100,000. They told you the implied value was 100,000, so that was given. Page 9. Then we take away the subs carrying value of net assets. Is this sounding familiar, or have you blocked it out? Common shares are 40,000, and retained earnings are 50,000. 90,000, which gives us 10,000 of AD. So now we're going to take away FV minus CV, or the fair value differential, if you remember. And what did we have to do to equipment? The fair value was 20, and the carrying value was 12. So it's got to change by 8,000. And we'll put the debits and credits in a second. We also have a DIT liability that we have to deal with. And its new balance, or fair value, is 4,400, and it used to be 1,200 from page 9. So that's 3,200. So we need to know whether these are positive or negative or what. So if we're making an asset go up, so equipment going up, this is going to be a debit, which means it's positive. We're making the liability going up. Is it going down? What? So you can calculate a little T account if you want. So DIT, asset or liability, started with 1,200. Its balance should be 4,400. So how much do we have to change it by? 3,200. And is that a debit or a credit? It's a credit, so it's going to be negative. So that works out to 4,800. You subtract that off, and you get 5,200 for goodwill. So all we've done, we still have the equipment going up. It's just there was also a DIT liability associated with it. And its balance is wrong on the subs books. We have to change it, just like the 12,000 was wrong on the subs books, and so we had to fix it. We're doing the same thing with the DIT. So now, based on that calculation, we've got to figure out what will the balance in the DIT on the consolidated balance sheet be. So the consolidated balance sheet is the parents plus the subs plus or minus changes in AE plus or minus realized, unrealized, and plus or minus basic transactions. If there were any. So we care about DIT, and we don't know if it's going to be an asset or not. So this is general. but we're looking just at DITs, which depends, we can keep it different. So what did the parents have on their books to start with? If you look on page 9, it says the very last sentence of the problem, the parent has a DIT asset totaling 15,000. So there's 15,000 DIT asset. Now the subs, and we want the new balance, is going to be 4,400. And it's a DIT liability, so it's going to have an opposite balance. So it's going to be a DIT asset, can't spell, of 10,600 on the consolidated balance sheet. Yeah, if there's any questions, you can just email me. Otherwise, you can just sit quietly. Last thing on this that I wanted to draw your attention to is, just so you know, with this DIT liability we have here, you're going to amortize that in changes in A over the asset's life. That word is over the asset's life. So if it was a 10-year life, each year you'd take off 320. So just like this goes on changes in AD, so does this. Okay, so you can read the text about operating loss carry forwards yourself. Not a big deal about that. But yeah, so that is pretty much the end of this chapter. There's just one little section on segment disclosures that I want to talk about on page 11. So, mostly you're going to read through this. There are a couple connect questions on this material. It's very straightforward. But just make sure you go through it. Basically, what we care about is when we do the financial statements and in the notes and extra information we give, what kind of segmentation should we do with our businesses? Should we just give them, obviously, for our main financial statement that gets audited, it is the total. But then, should we break it down into pieces? So, this segmented reporting is breaking our overall business into little pieces. Whether we are a parent and sub or we don't own any other businesses, just our own. And again, this is mostly thinking about public companies. So the identification of reportable operating segments is testable. So you can basically any of these three rules, so any of them, if a segment or piece, so let's say Alberta sales, were greater than or equal to 10% of all the reported revenue of the whole company, let's say across Canada, then yes, you should report it. Or the absolute value of the reported profit, so notice it could be a loss, but absolute value, remember if you have a number 3,200, it could be negative or positive. If it's in absolute value signs, it's both 3,200. Does that kind of ring a bell from junior high math? At any rate, if the absolute value of reported profit of a segment is greater than or equal to 10% of the whole thing, then you should report it separately. Or if the assets of a segment are greater than or equal to 10% combined. And I have given you a little problem to do. You'll see once you do it, it's really pretty straightforward. So anyway, take a look at that, and if you have any questions, let me know. Otherwise, that is chapter 9. So the next video will be chapter 10. Take care. Bye.